A seagull is not what you just find down at the coast, it's also a structure used in options. Now let's imagine that we have a situation where you think oil could go up. So what do you buy for if you think the price is going to go up? You buy a call option. So we're going to buy a call option on oil at $60 a barrel. Now that option is going to cost me, let's say for this, $5 per barrel. So I physically put $5 down. And I think, well, hold on a second, I think oil could go up, but I really don't think it's going to go above $65 a barrel. So what you do to reduce that cost is, having bought the call option for $5, you sell a call option at $65. Now what that means is if oil goes up, you're getting paid for it up to 65, because the call that you have sold at 65 offsets any benefit from the call you had bought at 60. But by selling a call at 65, what's going to happen? I'll pay you money. Now $65 a barrel is less likely to happen than $60 a barrel, so I won't pay you $5, I'll pay you, let's say, $2. So already what have you done? You've reduced the cost of your position from $5 to $3. $5 from buying the call, you've reduced the cost by $2 by selling the call, so far so good. Now the structure where you buy a call and sell a call at a higher strike is called a call spread. But you still have further opinions. You feel oil could go up, but it could go down, but I don't really think it will go down below $55 a barrel. So what you do is you sell a put at $55 a barrel. Well, what does that mean? What it means is if the price of oil goes below $55 a barrel, to let's say 50 or 45, somebody has the right to sell you oil, even though the market is showing $35 or $40 a barrel, they have the right to sell it to you and you have to pay them $55. But you don't think it's going to happen. You're happy to sell that put option to somebody else and earn a bit of money. Now again, will oil go down to 55? I don't know, but what I'll do is I'll pay you some money, but I won't pay you as much as the spot rate. I'll pay you $2 per barrel. So far, how do things look? You spent $5 by buying a call option at 60. You've earned $2 by selling a call option at 65. And by selling a put option at 55, you've earned another $2. So your net cost for this position, $1. What's the worst that could happen to you? The worst that can happen is oil prices just go through the floor, go down to zero, in which case the put option you have sold is looking, you're paying out a lot of money. But maybe you have a natural hedge, maybe you're happy to see oil prices go down elsewhere in your operation. And when you look at the payoff diagram, it looks almost like a drunken seagull, doesn't it? So flying on its side, where you have the head of the seagull in the middle, you have one wing, and you have the other wing going down like that. So they call it a seagull structure.